Hello and welcome back to The Note. History doesn't repeat itself, someone once said, but it does tend to rhyme. And hence there's great interest in learning the lessons from the Great Depression of the early 1930s and applying them to what has gone on in the policy response to the crisis of 2008. That is exactly the topic that this book, freshly published here in the US, aims to address. It's called Hall of Mirrors by my guest, Barry Eichengreen. Barry, thanks very much for joining me. Let's start by asking what were the critical lessons that policymakers learned from the 1929 experience that changed the way they acted in 2008?
The idea that when the private sector stops spending temporarily, government has to step up with public spending. Those lessons were learned. I don't think those lessons of history were perfectly suited to the circumstances of 2008, 2009, but they helped.
Could we talk about the counterfactual of what might have been done differently when it comes to the fateful decision to allow Lehman Brothers to fail? You certainly was felt at the time that in many ways that was an attempt to exert great discipline on the financial system, in the way you were describing, to combat moral hazard. Obviously it had catastrophic effects, at least initially. How differently could that have been handled using the lessons from the Depression?
Well, we had a similar situation in the Depression where the government saved a big bank in Chicago that was owned by the family of a former US Vice President, Charles Dawes. It came in for great criticism for having done so, and that led it to try to send a message to the financial system in 1933, not everybody will be bailed out. Henry Ford's Guardian group of banks in Detroit was not bailed out, and that led to the great financial crisis of 1933. I think the government and the central bank should not be in the business of sending messages about moral hazard in the throes of a crisis. They should have found a way to seize and stabilize Lehman Brothers. They were too concerned about moral hazard and about the political criticism that they had been subjected to after Bear Stearns. We would have done better in terms of having a less severe recession, not experiencing so great recession in 2008, 2009. What the longer term consequences in terms of financial reform of that decision might have been, I'm not sure. Who would have been elected president at the end of 2008? It's an intriguing counterfactual.
It's a very intriguing counterfactual. The fact that we can't answer it doesn't make it any less interesting. One final question, again coming back to where we are today, concerns monetary policy. The Federal Reserve famously made the mistake in 1937 of raising interest rates in hindsight too soon and provoked a further economic downturn. At the moment we're in this very strange situation where the Fed, for many reasons, if you look at the headline unemployment statistics, for many good reasons, appear to be preparing to raise rates this year, even as the markets worry about potential deflation. What are the lessons from the 1930s for what the Fed should be doing this year?
The lesson is that monetary policy is a very blunt instrument for dealing with financial excesses. If the Fed is concerned about frothiness in the bond market now, that's not a good excuse for raising interest rates. It's a good excuse for tightening regulation of the financial institutions that might have risky positions in the bond market that might again be over-leveraged. I think the Fed needs to wait and see that wage inflation is rising steadily at 2% plus before it moves. We don't know how much slack there is in the labor market, just as they didn't quite know how much slack there was in the US economy in 1937, 38. So monetary policy ought to be made on the basis of evidence about the current state of the economy. If you're worried about financial markets, the central bank and regulators have other macroprudential regulatory tools that are appropriate for addressing those problems.
Okay, Barry Eichengreen, thank you very much indeed. I hope that very brief conversation gives you some introduction to the lessons of history for where we are now. There's much more in the book itself. Please also look out for the review, which will be appearing in FT Weekend.